So we're starting chapter 4 on the income statement. So in chapter 3, we reviewed 3 types of statements: the income statement, the balance sheet, and the statement of retained earnings. And now we're starting on chapter 4, the income statement. The next chapter is going to be the balance sheet. So between the two of these, we're going to cover both of those statements in great detail. Now, the first part of the chapter is just a summary of different features of the income statement. And then the next part of the chapter is preparing an income statement. You say, but I've already prepared an income statement, right? But we're going to have more detail in the income statement, and we're going to go past the stuff you learned in principles to come up with a kind of more accounting-centric income statement like you would prepare in practice, and that is more theoretically correct. And then also another important, so that's one really important part of this chapter, is to prepare an income statement. It's going to be a different kind of income statement. The other one is to tell what would happen, various kinds of accounting treatment, and there's a table that we'll look at that kind of summarizes these. And we're also going to do a retained earnings statement, which not much new is there. Okay, so today we're going to go over the first part of the chapter, and we're also going to get to the part prepare an income statement. So we're going to get to the part where we do a multi-step income statement, which is what we're, trying to come to. Okay, so this first part of the chapter is the theoretical part of the chapter, and we're just going to talk about various things that make the income statement, that are good, positive, good things and bad things about the income statement, and maybe some, problems with it. Okay, as you saw, the test has some questions on it that are kind of conceptual, right? Those questions are, the best way to learn that kind of stuff is by reading the book and not by looking at the PowerPoints, okay? So just think of the PowerPoints as an overview or an outline, but, make sure that you read the book and this chapter and other chapters to get all of the details, okay? How many of y'all read the chapter twice? Yes? No? Yes? Okay. Reading the chapter twice is usually what you need to do, okay? The first time is a big overview. The second time, you really get the details. So if you can't read the chapter twice, for first chapter, the first time you read through, at least highlight the important things so that you can go back and look at your highlighted items the second time, okay? So if you feel like, well, I don't have time to read it twice. But to do well, usually you have to read it twice. Now, your goal in this class is not to do well enough to make a certain grade, Your goal in the class is to learn this well enough to provide a foundation to do well for the rest of your life, This is the kind of class where you want to learn this stuff so you can pass the CPA exam, so you can do well in business and that kind of thing. So, try to learn it 100% so that you'll be confident when you go out in business, okay? All right, so what is the income statement useful for? There's really 3 major things that they talk about, and one is to look at a company's past performance. Okay, so what is the income statement is for a period of time that is in the past, right? So it informs the financial statement users about what happened in the past. Well, what is that good for? So then they can compare that company with other companies, other similar companies, or companies that they're maybe thinking about buying stock or loaning money or whatever. They compare this company with other companies to do what? To make decisions. That's the most important, reason for these financial statements is for decision making, okay? But really, what do the primary thing that the users want to make decisions about is they want to be able to predict the future. So they want to be able to use these past results to predict the future. What things are they concerned about the future? Future cash flows. That's their primary thought process. if you're going to invest in a company, you want to get future dividends and you want to sell the stock at a profit, right? So that's the cash flows they're looking at. So you want to predict future performance, and you're looking at trends in the performance, whether the company is trending up, trending down. Okay, so like I said, the primary purpose of looking at the statements is to make decisions, and to do that, they want to be able to predict cash flows. Well, the income statement, not only can they predict the amount of the cash flows, but they can also see how risky those cash flows are. So what do I mean by risky? Some cash flows you can depend on more than others. Some cash flows of the companies you can depend on year after year more than others. What type of cash flows would those be? There's really a couple of different kind of cash flows in the company, right? What does the company make money by doing? What's their primary source of income? Y'all are shell-shocked. What does Walmart make money by doing? Selling their product. Okay, so that's one kind of cash flows, the cash flows from operations. What's another kind of cash flow? What kind of other thing does Walmart make money by doing? Okay, like let's say maybe selling land, selling a plant site, selling something extra that they have that has nothing to do with selling their product. They have other cash flows that are not ordinary. They're not in their normal course of business. So an important part of this chapter is we're dividing cash flows into cash flows from operations and cash flows from not from operations, okay? Why do we do that? Because which ones are more predictable? The cash flows from operations, right? Walmart's selling their goods and services are more predictable than if they were to sell land or some other random thing sometime during the year, okay? So what we want to provide is an income statement that is able to help them differentiate these two types of cash flows. Now, let me just talk about one thing. We're talking about cash flows here. Does the income statement tell you anything about cash flows? What does the income statement tell you about? Revenues and expenses prepared on which basis? The accrual basis or the cash basis? The accrual basis, that's why we do these adjusting journal entries, to bring the income statement to the accrual basis, okay? So now do you see the problem? We're saying that the income statement is useful to tell us something about cash flows, but now we're saying it's not prepared on the cash basis. But the thing is, we have a way to change the income statement numbers to the cash basis. This seems kind of backwards. We put it on the accrual basis. Now we can manipulate that number to get it to the cash basis. How do we do that? What statement tells us about cash flows? The statement of cash flows, right? That's one of the four main statements. We really haven't talked about that yet, but we're going to talk about that in Chapter 5, okay? So the thing is, even though the income statement is not on the cash basis, we can convert it to the cash basis, and companies do convert those income statement numbers to a cash basis to give better information about cash flows. So the accrual basis, is it a better way of doing business than the cash basis? Yes, because it provides better information. But we do have to, if we want to look at cash flows, translate those numbers into cash flow numbers to help investors make decisions, okay? All right, so there's a couple of limitations of the income statement. Some things don't go on the income statement because we can't measure them. So remember that to put something on any financial statement, it has to be measurable. And if something is not measurable, we don't put it on the income statement. So some things are left off. And then also, the income statement is affected, the numbers on the income statement are affected by items that we used certain accounting methods for, and that affects our income statement number. For instance, whether we choose LIFO or FIFO inventory will make a tremendous difference to the income statement number. Okay, so LIFO and FIFO inventory, I don't know if y'all remember that from Principles 1. You know, it's a big decision that a company makes which one they're going to use, and they usually stay with that decision, you know, indefinitely. But that will impact income. The way that you measure the cost of goods sold going in and out using LIFO and FIFO will have a dramatic effect. So therefore, on the income statement, in the notes to the income statement, a company discloses which method they use, and investors can, you know, adjust their income statement number to reflect the fact that they're using a certain method of inventory. And that's not the only thing. Some companies use an accelerated method of depreciation, and some use a straight line method of depreciation. So if you use a straight line method of depreciation, you're going to get a different expense than if you use an accelerated method, right? So depending on which method you use, so if you use an accelerated method of depreciation, are y'all familiar with how that works? Okay. What that means is you're accelerating the depreciation to where more is recognized up front, okay? So more depreciation is recognized up front. If you use the straight line method and it's $10,000 over 5 years, that would be $2,000 a year. If you used an accelerated method, it's, let's just say, for an example, 10,000 divided by 5 times 2. It would be $4,000 the first year. See, that's a big difference. You're doing twice as much depreciation the first year. It's going to end up, and then the next year it'll be slightly less than that. But the point is, how's that going to affect your net income if you use an accelerated method of depreciation? Your expense is going to be up, right, under this method, which makes your net income go down, right? So net income would go down. Why would you? Most companies use an accelerated method, and why do they do that? To bring their net income down. Does everybody want less net income? Is that the reason? Why do they do it? Because net income affects your taxes. Okay, so if your net income goes down, your taxes also go down. So that's why they use accelerated method. And there's all kind of, in this middle one, net income is affected by the accounting method selected. Usually companies select their depreciation method and their LIFO, FIFO inventory method because of the tax effect, okay? All right, which makes accounting seem like a bunch of mumbo jumbo and made up numbers, but people are able to discern all of these rationales behind there and somehow come up with a number that they're comfortable with when making investment decisions, okay? So then also the income measurement, there's a lot of judgment involved in certain decisions that companies make. So what kind of decisions would that be? Estimates like the bad debt decision. So a company, remember, has to estimate how much to put in the allowance for doubtful accounts. They do not know who's not going to pay them. When they make that bad debt expense entry, that's an estimate. And there's several other estimates that might affect net income, okay? So the quality of earnings is a big buzzword now with the SEC. So earnings quality to the SEC and to the PCAOB and to investors means that that people can depend on the earnings to give them a true picture. And there's one reason that people may not be able to depend on the earnings is because there's some degree of earnings management in the numbers. Okay, so what do I mean by earnings management? Companies have an incentive to manage their numbers to manage their net income numbers in a particular direction in order to influence their stock price, okay? So does the company want their stock price to be high or low? High. They want the price of their stock to go up. Why is that? Because management usually gets stock options. They get maybe bonuses based on how the stock price goes. So they want the stock price to go up. So what they would like to see is their earnings per share number or their stock price to go up like this. And instead, companies' earnings rarely go in a straight line like that, and they usually, go more like this, okay? They kind of have dips and things, okay? So, but what management might rather have is a more of a straight line, more of a predictable straight line. And so management has a tendency, to bring this number down, this net income down and that net income up to be more of a straight line, okay? And then also management has an incentive to meet Wall Street expectations. So if Wall Street expects this number, management has an incentive to get their number up to that number, okay? So these are all things that reduce the quality of earnings. Now this point right here, earnings management, this is a definition of earnings management, planning your income to smooth out bumps in earnings. These are the bumps in earnings. See how it's bumpy rather than smooth? They're trying to smooth out the bumps. And maybe cookie jar reserves is one way to do that. When you have too much earnings, like you have right here, this is perceived to be too much earnings compared to their straight line. They book some kind of reserve, make an estimate change so that they feel like they have earnings in the cookie jar saved up for a rainy day when the net income might be down here. Okay? So another thing I wanted to talk about is classification shifting right here. So earnings, like we've talked about, we think the operating earnings are more dependable and they're higher quality earnings than non-operating earnings. So companies don't need to put their earnings in the wrong category. Okay, so if they were to put something that's not operating earnings in the operating category, then that would be deceptive. And what that's called is classification shifting, okay? And real earnings management, what that is making changes to your expenses with the purpose of impacting earnings. So like changing your advertising expense so that it will impact your net income number, which is really, fairly legal. But if you see that companies are doing that to manage their earnings, then it impacts the quality of those earnings, okay? This is all very theoretical, right? Are you following this discussion? Somewhat? Okay. All right, so the format of the income statement. Now we're getting into the technical part. So what we're saying there is the elements of the income statement. Does anybody recognize that word elements? Elements, that's from chapter 3. That was one of the words in the triangle, remember? And there were about 10 elements. They were in a box in chapter 3. And the ones that pertain to the income statement are revenues. Let's see if we have a slide on this. We really don't have a slide, but let's just name them. Revenues. And what's the thing that's kind of similar to revenues, but it's not revenues? Gains, okay? Revenues and gains, and expenses and losses. Okay, so here you see gains and losses right here. So one thing that we want to do is separate these are the 4 elements of the income statement, 4 elements that pertain to the income statement. Remember, some of the elements pertain to the balance sheet, but there are 4 elements that pertain to the income statement. And those are revenues, expenses, gains, and losses. Okay? So what we're going to talk about here is what is the difference between revenues and gains? What is the difference between expenses and losses? And why do we care? Because we want to separate those on the income statement to give better information to the financial statement users. Okay, so which ones of these are more dependable kind of earnings? Revenues and expenses have to do with the major or central operations. Okay, so that is revenue or expenses from operations. Those revenues minus those expenses would give you your income from operations. And income from operations is a number, is a subcategory on the income statement in the multi-step income statement. Okay, so we're building up here to get to the multi-step income statement where we're going to separate out the income from operations from the income not from operations. So in other words, 2 of these 4 go in the income from operations. The other 2 do not. So you see what I'm saying? Revenues and expenses go in income from operations. The other 2 do not, because revenue and expenses pertain to the major or central operations. And therefore, they have a higher earnings quality, like we were talking about in the last slide. They have a higher earnings quality because they're in those major operations. Okay, so here are a bunch of revenue accounts, but usually in the ongoing operations, sales are the ones that are from operations, and some of these others are not, okay? Here are a bunch of expense accounts, and cost of goods sold is from operations, and we'll go into some of the rest of them. All right, so now from peripheral transactions or incidental transactions, that's periphery, out on the edges, not in the main thing, then those are gains and losses, and they tend to be from a sale of something. You're not going to sell an investment or a plant asset every day. So when you do, that's not part of your major operations. And there's some other examples there. Okay, so now we're going to prepare an income statement. So let's look in the book. What we're going to do is we're going to look at the book and at an example of a multi-step and a single-step income statement. And that would be on page 165 and 167. Okay, so and 168. Okay, so we're going to start on page 168. We're going to start on page 168 because on page 168 we have a single-step income statement. All right, so in a single-step income statement, what does it look like? What does it look like? What's its formula? Right. So it's revenues, expenses, and then down here is net income. So it's revenues minus expenses equals net income, right? So what do you notice about the revenues? The revenues are all listed in the revenue section, right? All the revenues are listed. What about the expenses? Every single expense is in the expense section, right? Okay, now we have a net income number. What do you notice unusual right beneath the net income number? Earnings per share. Is that news? That's a new thing, right? So that's one thing that we're going to learn on our income statement. Right after net income is an earnings per share number, okay? So from now on, just about every income statement you do will have an earnings per share number. So how does that work? We say net, here we have revenues minus expense, and we have a single line, and then we have a double line under net income. See that? Then we have another double line under earnings per share, okay? Now, what does the earnings per share number tell us? It tells us how much this company earned for each share of stock. Why is that important? Because the primary financial statement users are the stockholders. They want to know how well my stock did. Forget that Walmart made $900 billion. How much did my share of Walmart make? Do you see the difference there? They invested a certain amount of money in Walmart and bought a certain number of shares of stock, so that's what they care about, me, right? Okay, so this is a single steps statement. Let's look instead on page 167, and we're going to look at a multi-step statement. All right, so what is the formula for a multi-step statement? It's much more complicated. Where are our revenues? Remember we had sales revenue, dividend revenue, and rent revenue. All right, where did sales revenue go? Sales revenue went right up at the top because it is part of the operations. But dividend revenue went where? It's lumped in there. It's maybe hard to find it, right? It's lumped in there in something called other revenues and gains. Do you see that other revenues and gains is the total of dividend and rent revenue? Okay, so it's in a place called other revenues and gains, and why is that? Do you see the income from operations number? Income from operations? And then beneath that is other revenues and gains and other expenses and losses. So my point is that, we only put the revenue from operations up there in operations, and then we put the gains and the losses down there after operating income. So we've separated out our revenues. Why is that? Because now we know that this company made $186,000 from operations, and their net income from the year was $164,000. So see, this gives us better information to tell us how much they made from operations. Okay, and the net income number is the same in both of these. Notice the net income number, the $164,000, is the same no matter if you use a single step or a multi-step, okay? But it's just where you put it that matters, okay? So we're going to look at this multi-step, and we're going to see what the format is, get this seared into your head, and then you're going to come up to the board and do a multi-step. How about that? Big eyes, right? Okay? You're going to come up to the board and do a multi-step or do a single step. Half of y'all are going to do a single step, half of y'all are going to do a multi-step, and I've got some numbers here for you, okay? So we're going to see how y'all come out with the net income number. Now, okay, yeah. How do you think we're going to come out on this? We're going to come out fine, right? Now, one thing we have not talked about to date, and that's in this problem, is we've kind of ignored taxes to this point, haven't we? How do you calculate taxes? How do you calculate taxes? You get a net income number, and you apply some kind of tax rate, and you come up with the tax number, right? Okay, so what I've given you here on this problem is the tax rate. So what would you do? If you made $1 million, you'd multiply your $1 million times your tax rate, and you'd get the tax expense, right? Okay. All right. So now, first I'm going to do is kind of erase this and, going to give y'all this, and half of y'all are going to be single step, half are going to be multi-step, and you two guys are going to split. I'm going to just do it in the group way, okay? So, so you guys back here are going to be single step, and you guys right here are going to be multi-step. And, yeah, I might have given you one too many. And then you guys are going to split up. One goes single step and one go multi-step, okay? So what I want you to do, so the single step people just come up to the board here and start writing, right? Well, actually, let's try to keep it in this spot right here for the single step and this spot over here for the multi-step, okay? So here's the single step people. Have y'all got the single step? You got the formula, right? That one in the book? How it goes? Yeah, just have at it. Multi-step, you see how it goes? Was Britsky. I think it was maybe a brief exercise. Yeah, it was brief exercise number 2 in your book, Brisky. So remember, I think I've posted the solutions to these, online. So you can go and look at these problems. Now, what did we learn from this? Did y'all learn something from doing this, did you think? Rather than me, I could have stood up there and said all this, right? But you tell me now, what are the differences between the single step and the multi-step income statement? Okay? Everybody tell me a difference.
Well, with the expenses, we would think that administrative expenses would go with the other expenses and losses.
You would think. So now you learned where selling and administrative goes. Okay, so selling and administrative are the 2 primary kinds of operating expenses. Usually companies divide their operating expenses into 2 kinds of expenses, selling and administrative. Selling has to do with selling their product. Administrative has to do with corporate offices and such, okay? So these things are associated with the main product, all of these things, okay? It takes a company president to have a Walmart, So the company president goes in this administrative stuff, okay? Because he is involved. What is this number right here? Income from operations. What kind of income is that? That's your continuing income that people depend on, that's more, has a higher quality, because it's going to be persistent over time and hopefully be more constant. What are these other things down here? These are the 2 elements, remember that word, that are not from operations. Other gains and losses, okay? These are the unusual things, okay? So what we did, we came up with an income from operations and subtracted these other things, and we got income before income tax. So how'd y'all find that? Yeah, on our multi-step income statement, we come up with the income before income tax. Another way of saying that is taxable income. Like on your own personal tax return, this is what you do. You take all of your income, subtract all of your items of expense and stuff, and you come up with something called taxable income. You calculate the income tax, and that's, your tax. That's your tax. That is an expense. So it has to be, over here, it's included in with the expenses. See that on the single step? The tax expense is included with the expenses. So you had to come up with the taxable income number, calculate the tax expense, and then come up with total expenses. Tax expense is included in the total expenses, and it usually goes where? Where's the tax expense? Last thing. It's usually the last item in your expenses. Now, what's another thing that we notice about these expenses? Ordinarily, the expenses are listed in decreasing order. So the biggest expense is up at the top on this list. Okay? So that's ordinarily the order of things. Okay. So, one thing that you could do if you were going to have, they had just one column here. You could make two columns and put this out in a separate column if you wanted to. But in your example, you had just one column. So, yes?
So what would be another example of another expense besides interest?
Besides interest. Okay, it's like a loss on the sale of something. Okay, so like if you sell something at a loss, like you sell a piece of equipment, you sell a piece of land or some kind of long-term asset or an investment, like an investment in another company. If you sell something like that at a loss, that would go in there too.
And would you say loss on sale?
Loss on sale of something. That's the primary thing that goes in there. And then interest goes in there. Yeah, that's the main thing. Okay. Anything else? Oh, earnings per share. How did we calculate earnings per share? How did y'all do that? You took net income and divided by number of shares. Where'd y'all get that idea? Sounds like it, right? Earnings per share, number of shares. Okay, is there a place in the book that gives you a formula for this, for earnings per share? In this chapter, this is one of the things we're learning in this chapter. We're going to skip ahead to that. On page 177. On page 177, it tells us something about earnings per share. And the formula looks a little more complicated than what you said, right? Okay. Earnings per share is earnings per common share. This is what we're trying to calculate, earnings per common share. Now let's think about that for a second. We have usually two kinds of stockholders, common stockholders and preferred stockholders, right? Which ones sound like they're the fanciest and the, preferred, right? Why is that? What kind of things are they preferred in? They're preferred in getting their dividends first. They get their dividends first. And if the company is dissolved, they get paid back first, okay? So those guys are fancy guys. We're going to take them out of the equation and just calculate earnings per share on the common shareholders who have to depend on preferred shareholders get a certain percent. Let me say that first. If you buy preferred stock, it'll be like preferred 4% stock, and you get 4% of the earnings. Or it might be preferred 5.5% stock. You get 5.5% of the earnings. So see, you have like a guaranteed number that you get. What do common stockholders get? No guaranteed number, no payback. They just get, if we make money, you get money. If there's any left over after preferred shareholders get money. So you see, the order of events is we make money, we give some whatever guaranteed amount to the preferred stockholders. If we feel like it, we'll give the common stockholders something. So common stockholders have to depend on a lot of net income to get anything. So when we calculate earnings per share, we're going to subtract out what? The preferred dividends. See, in our formula there, we subtract out the preferred dividends. Why is that? Because of what I just said. Common stockholders don't get anything until after we pay the preferred dividend holders, right? So this one's, it was the simple equation here because we only had common stock and this problem that we worked. But when we get more complicated, we subtract out the preferred dividends, and then we also, this number of shares, this is number of common shares, and it's a weighted average, okay? So what do we mean by that? We're only worried about the common shares. That's why we use the number of common shares. And the weighted average means the weighted average of shares outstanding all year long. It might be that you have the number of shares change during the year, but you're going to weight that to get an average number. Okay, it's not a simple average, like beginning of the year plus end of the year divided by 2. That's a simple average, but it weights it for how many days that number of shares was outstanding. Okay, so we'll have a problem about weighted average, but I just wanted to talk about this a little bit now so that you could see how that worked. Okay, so let's just look at these. There. Okay, so let's look at these slides real quick. The multi-step income statement, we've talked about that. It highlights certain components of income. What do we mean by that? It highlights this income from operations, okay? We have an operating income section. An example of a multi-step, you could list out all of your selling expenses and get a subtotal. See how this one does? List out all of your administrative and get a subtotal. This income statement here just shows you all of the components that are included, that may be included, well, not all, a lot of components on the multi-step and the different sections of them. Or this is the condensed one, which looks more like this that you guys did, the condensed statement. So single step means that our single step is to take revenues minus expenses. Multi-step, okay, this one is simpler, easier to do, and it seems to indicate that neither one of these expenses are more important than the other one. On the other hand, the multi-step seems to indicate that this kind of sales is a better kind of sales than any other kind of revenue. Okay. Do we get the same answer under the single step and multi-step? Yes, we get the same answer. Okay. We get the same earnings per share. Everything's the same. Okay, so now next time we're done with this section of the chapter, and next time we're going to go over into unusual items. So let me just say, if you don't do anything else, look at page 177 in the box on page 177 and look at those items, because those are one of the major things in this chapter. You want to try to understand the things in that box and maybe read a little bit about those so that when you come here, it's not completely, this is all brand new. So you don't want it to, you don't let me be the first one to tell you about this. Read about it, and then when I talk about it, then it'll make better sense, okay? All right, so I'll see y'all Wednesday.